In part 4, we will discuss the public determinant of money supply in the economy, which is influenced by the desired currency to deposit ratio. This desired currency to deposit ratio depends upon interest rate on checkable deposits, fees on checkable deposit, income of the public, probability of bank failure, and illegal activity. So we will find all the 5 factors which influence the public determinant of money supply in detail. Let us understand the public determinants of money supply. That depends upon the desired currency to deposit ratio, which means the desire of the public to hold currency in hands and lending deposit in bank. We all know that if the public is having more desire to lend money to the bank as deposit, this is going to increase the money multiplier process, because if the bank is having higher deposit, it will increase the credit creation and money supply will increase by multiplier times. But if the public is having more desire to hold currency, it is going to reduce the deposit in banks and it is going to reduce the credit creation and money supply is reduced by multiplier times. So we can say that desired currency to deposit ratio is approximate determinant of money supply. It is not an absolute determinant of money supply because it is behavioral in character. It depends upon person to person, their choice of holding currency in hand or depositing money in the bank. So if the public want to make fewer cash transaction, they will be holding less currency or less cash in hand. Holding less cash in hands means the currency to deposit ratio is less. Less currency in hands means more deposit in bank, which will be increasing the complete money multiplier. So if the currency ratio is less, it is going to increase the value of this multiplier and therefore increase the money supply in the economy as a whole. So we can say that the desired currency to deposit ratio therefore depends upon the choice of the public. Whether the public is having more choice of keeping currency in hand, that is going to reduce the money supply in the economy. But if they have a choice of keeping more of checkable deposits, that is going to increase the money supply in the economy. So now let us find out what are the factors which are responsible for the public choice of holding currency in hand or keeping checkable deposits in bank. So those factors are interest rate on checkable deposits, fees on checkable deposits, income of the depositor, probability of bank failure, and the illegal activity. So we will understand all these factors one by one and how they impact the public choice or the desired currency to deposit ratio of the public. So now let us see the first factor which influences the public determinant of money supply is the rate of interest or interest rate on checkable deposits. We all know that public has a choice. The choice between holding currency in hands or keeping deposit in banks as the checkable deposits. Whenever they need that money, they can easily withdraw it from the checks. So they are called checkable deposits. But holding money in form of currency is a sacrificing the interest rate that might be earned on deposits in bank. So that is an opportunity cost. You are sacrificing the interest rate that you might earn if you deposit that currency in the bank. So if the interest rate on checkable deposit increases, attractiveness of holding currency is definitely going to fall or decline. As a result, this currency to deposit ratio is going to fall. People will hold less of currency and more of deposit in banks. As a result, there will be increase in the money supply in the economy. Second point is fees on checkable deposits, which influence the public determinant of money supply. We all know that banks charges fees on checkable account. These fees include monthly maintenance charges and fees charges per check or ATM withdrawal. These fees are basically the cost of holding money in the form of bank deposits. Now suppose if bank decides to reduce the charges on checkable account, this is going to decrease the currency ratio because attractiveness of holding money in form of currency decreases. Holding currency means it's an opportunity cost in terms of sacrificing the interest rate what you can earn by depositing your money in the banks. So if the fees on maintenance charges, withdrawal amount decreases, this is going to decrease the currency and increase the deposit ratio. As a result, the money supply will increase. But if the bank increases the fees on checkable account, this is going to increase the currency ratio. Attractiveness of holding money in form of currency will increase. This is going to reduce the deposit in banks. As a result, money supply in the economy will be reduced. Now it is interesting to know that in India from 1st November 2020, banks are charging fees on cash deposits and withdrawals. As per RBI directives with effect from 1st January 2022, banking customer would be required to pay rupees 21 per transaction on ATM cash withdrawals beyond the free permissible limit. Now what is this free permissible limit? It is the limit on the depositors. They are eligible for 5 free transactions every month from their own bank ATMs and 3 free transactions from other bank ATMs in metro centers and 5 in non-metro centers. So if these fees are charged on checkable account increases by the bank, it is going to increase the currency ratio. Attractiveness of holding money in form of currency would increase and this might lead to the reduction in money supply in the economy. The third public determinant of money supply is income of the money holder, which influence the desired currency to deposit ratio, which varies between the high income group and the lower income group. If we talk about the high income group, money holders with higher income tend to be more sophisticated user of financial systems like banks, financial intermediaries. They rely more on the financial systems than on currency for their transaction. Whereas lower income group, money holders with lower incomes are more likely to use currency in their transactions. They rely less on the financial systems like banks than on currency. As a result, we can say that the higher the income in the economy, the lower the currency to deposit ratio and larger the money supply in the economy. Coming on to the fourth point of public determinant of money supply, which is probability of bank failure, which influence the choice of the public either to go for holding currency in hands or depositing money in the bank as a checkable deposit, which influence the currency to deposit ratio. Now suppose the probability of the bank failure in our country increases. This is definitely going to reduce the confidence of the public in banks. As a result, money holders tend to abandon deposit in favor of currency in hands. This widespread incidence of bank failure affecting numerous institutions is called bank panic. Bank panic triggered a movement towards cash. As a result, the currency ratio in the economy will increase. People will hold more of currency in hands and less of deposit in bank. This lead to increase the currency ratio and decrease the money supply in the economy. Because less of deposit in bank will reduce the bank power of credit creation and therefore reduce the money supply by multiplier times. Now coming to the another situation, if your country is having a strong banking setup, the probability of bank failure decreases. This is definitely going to increase the confidence of the public in the banking system. Therefore, money holders tend to abundant cash in hands and they favor more deposit in banks for financial transactions. So the choice of the public for checkable deposit increases. As a result, the currency holding is going to decrease and the deposit in a banks is going to increase because people will more deposit money in the banks to earn interest income on it. So leading to fall in the currency ratio. The more the deposit in banks will help the bank in credit creation and that will lead to the multiplier times increase in money supply in the economy. So in order to increase the money supply in the economy, the country should have a strong banking setup. The probability of bank failure should be avoided for having a more money supply in the economy. Coming to the fifth public determinant of money supply in the economy is illegal activity. Now, what is this illegal activity? It is the part of the economy that is unrecorded in official measurement of economic activity because it consists of illegal activities, that is unrecorded cash transactions. It includes drug dealing, illegal gambling, tax evasion, etc. This leads to more of cash transaction in the economy as cash is an easy medium of choice for illegal activity and it is used to make unrecorded transaction. International studies show that the black economy is referred to by more than 30 different names in the world like black money, parallel economy, informal economy and so on. So if there is increase in the illegal activity or underground economy or a black economy or informal economy, it is going to increase the currency ratio. The transaction in the currency will increase and the deposit in banks will fall. As a result, the money supply in the economy will fall. So this means the higher the illegal activity, the lesser the money supply in the economy. So illegal activity is a major challenge to Indian economy. It comprises almost 62% of GDP. India's black economy is generating about 93 lakh crores of revenue, which is equal to 14 trillion US dollar. It is more than the 39% of GDP or income generated by agriculture and industry put together, and more than the size of government spending, including both center and state government, which is almost about 27% of GDP. So, because of this black economy in a huge amount, comprising 62% of the GDP, Indian economy has been losing on average 5% growth since the mid 1970s when the black economy became significant. So now it is clear that illegal activity promotes cash transaction and discourage deposit in banks that in turn reduce the money supply in the economy. So in order to reduce this illegal activity and to control the parallel economy or black economy, Prime Minister Narendra Modi on 8th November 2016 at 8 p.m. on national television announced demonetization. He demonetized 500 and 1000 rupee bank note, which comprised almost 86% of the currency in circulation. These notes were banned and became invalid 4 hours later. The main aim of demonetization was to flush out the black money, that is, fund hidden from the taxman. However, three economic objectives were offered as a rationale behind demonetization by the government. Number one was wiping out black money from India. Number two was eradicating fake currency notes in circulation. And number three was creating a cashless economy by pushing digital transaction. Among all these three targets, the biggest one was tackling the black money. However, according to the Reserve Bank of India data 2022, almost the entire chunk of money, that is more than 99%, that were invalidated came back into the banking system again. Of notes worth rupees 15.41 lakh crores that were invalidated during the time of demonetization, note worth of rupees 15.31 lakh crores returned back again to the economy. If you have any questions on this presentation, please leave your questions in the comment section and like and subscribe my channel to get further notifications. Thank you so much.